All right, so we're going to go ahead and get started. Hopefully you got the handout here, so we will just go off this handout a little bit, but we're mainly focusing on building your own investment portfolio. What I like to do before we actually get started actually covering the material is actually kind of see what your comfort level and where you are when it comes to this topic. So if you will, I'll introduce yourself and tell me about what you know at this level.
I'm Cody and I know nothing.
Okay. Okay.
Yeah, and I'm Abby and I don't really know anything either.
Okay. And so another question I have is, what made you decide that you wanted to come and learn a little bit about this?
Because investments are good and you can make money and profit them eventually.
Yeah, I mean, at some point in your life, you're probably going to want to retire one day.
Yeah.
And so if you are not addressing this early, what you're going to find, and I have a lot of friends, that I grew up with who, they don't know the first thing about investing. I mean, I didn't know the first thing about investing, growing up. I mean, it just in our household, that just wasn't an issue that we talked about. And so, but now I'm seeing, people that I know and, some other people that they want to retire, but they can't. They didn't save like they were supposed to. They didn't invest. And so many of these individuals are probably going to be working until the day they die. Now that doesn't mean that they'll work full time, for their entire life. But it seems to me like many of them are not going to be able to retire when they get Social Security. That they're still going to have to continue to work, in order to survive. And so I guess that for me, I don't want to be in that situation. Now I may decide, hey, I love work. I want to work, for a long time. But I've always wanted to have the option of being able to retire if I wanted to. And so we're going to talk about things that you need to be doing. We did a workshop a couple weeks ago. That workshop was more geared towards learning about emergency fund, learning how really to save money, and then make sure that you're financially secure before you really start investing. Because the one thing that you're going to learn about investing is there's always risk. Everything that you put into the stock market, there's always the potential that you could lose it. And so, you don't want to put your entire life savings and not have an emergency fund and put it all into the stock market because, the market goes up and down. So you could potentially lose some. And if you really need to draw that money out quick, you could take a pretty big hit. So you've got to be financially secure enough where you don't have to keep getting into that money, because you have to think long term. So we will look at that. If you notice on here on the screen, that's my blog. So yes, I have a blog, my own little financial blog there. My shameless plug. But there are some resources that we're going to look later on where I think you can go, I have various calculators that you can go to for the millionaire calculators where you can actually see exactly how long it would take you. You put in how much you want to save every month and it'll show you how long it will take you to get $1 million. And so there's a lot of different calculators on there, just a variety of different resources that you can use. Obviously, I post something. I try every week to post something. There's various topics that I cover, whether it's a Roth IRA, which we'll talk about today, or just saving in general. I even have cheap snacks that you can make, to save money, so you're not having to go to the Lion's Den every single day. You can actually make your own stuff. And then kind of bring it out. So there's a variety of different things, but I will also show you some other resources of other blogs, because I think it's important not just to focus on mine, but to look at a variety of different blogs out there, because there are so many different types that are geared towards millennials. And so I'll show you where you can go to learn more about that. But my first thing, because we'll look at this handout that you have. So right there at the very beginning, one of the things that it talks about is that you really need, to invest in an index fund, I think. For at least the first $10,000 that you save should go into a well-diversified index fund. And what I mean by index fund is basically like a mutual fund. It's well-diversified. You're putting your money into a variety of different stocks. In some cases, you're putting your money into thousands of different companies. And so you are spreading out your risk. So instead of putting your money all on one company, you're just spreading it out, evenly into a variety of different companies. And then an index fund, basically, it's kind of geared towards the market. And so, as the market goes up, so does most likely your index fund. Because even though one stock may be not doing well, others will offset that because they are doing well. So it's really a safe way to invest. So if you don't know hardly anything about investing, that is the first step, in my opinion, is get into your first 10,000 into an index fund. Now the problem is that there are a ton of index funds. I mean, you can get lost in how many different ones that are out there. And so we will kind of narrow that down a little bit and talk about which ones you could go into. And so the first option that I listed on your handout there is the Vanguard Total Stock Market Index Fund. That one is basically, Vanguard is a company, who manages these funds. So that is the actual company's name, Vanguard. The Total Stock Market Index Fund basically tries to capture the entire U.S. market, pretty much. So I mean, it's invested in thousands of different companies. And we'll look specifically at which companies that they're investing in a little bit. But to me, that is a pretty good safe option, that you can take. It doesn't really require much effort. Basically just put your money in there, and you really don't have to actively do anything, which is nice. Just put your money in there. And I would say, once you start investing, you do want to kind of get in a routine of when you want to invest. Always choose a number of how much you'd like to invest and try to stick with that. So like for me, when I first started, I first started just saving, putting it into a regular savings account. I started off at $50 a month, and it actually took me 2 months because I couldn't open my savings account until I had $100, to open the account. And so it took me 2 months. I said, $50 each month. Now I save on average $2,000 a month. And so normally it's more than that, but that's my benchmark I have to hit every month. I have to save $2,000 a month. And so I started off small and I was able to slowly work that up. Normally I save on average, it equals out to, after we take out taxes for my wife and I, it's about 38%. We save typically around 38 to 40% of our take-home income, and we use that to invest. And so, and we spread it out to a variety of different areas. And so, another option that you could look at is the Roth IRA or traditional IRA. That is another option that you could potentially look at. I think everyone should have one. Most likely you're going to graduate, you're going to get a job, your company is going to offer their own retirement system. Most likely it'll be like a 401k or something. But don't rely solely on that. If you're relying solely on that, you might not have enough towards retirement. And so what you need to do is in addition to whatever your employer offers you, you should get your own retirement set up. And so that's why the Roth and the traditional are some of the more common options that people have. Like I, for example, have a Roth IRA. And so my first question to you is, do you know the difference between a Roth versus a traditional? Okay, so I'm going to tell you a little bit. I'm just going to give you a snapshot of it. So the first one, the Roth. So a Roth IRA basically allows people, and it kind of goes off your income, how much you make, but typically you can put in a certain amount every year. It's $5,500 a year that you can put into a Roth IRA. A Roth IRA, there are some limitations. So like for example, it is a retirement account. You cannot take that money out. So once you start putting that in, you will be penalized heavily if you take that money out early. You can't start withdrawing money from it until you're 59 and a half years of age. And so in some ways, it's a way to protect you from yourself. Because if you put your money into like a regular stock or a regular mutual fund where you have access to it any time, there might be more likelihood that you would take money out of it at some point. With the Roth or traditional, you're not going to want to do that because you will be penalized pretty heavily tax-wise. So it is a way for you to invest. Now, a Roth allows that there is no limit on how long that you can contribute money into that. So let's say you decide I don't want to retire at 70. Let's say you're in great health, you love what you do, you want to continue to work. You can continue to put money into that Roth. Even after age 70. Also, taxes-wise, you pay all your taxes now. You pay as you go, your taxes. So that way in retirement, when you start withdrawing money from there, you don't pay taxes on it because you already paid the taxes on it, which is nice. So that's actually going to help you quite a bit, you know, once you retire, because, I mean, you're not going to pay taxes, because you've already done that. But also, one of the reasons why a lot of people go with the Roth is because they are banking that most likely 20, 30, 40 years from now, taxes will most likely be higher. So, if you pay the taxes as you're going now, chances are you're going to be paying at a lower rate versus when you retire. So that's one of the reasons why people go that route. Like I have a Roth, IRA. I like the flexibility. It seems like to me it has a little bit more freedom versus the traditional. Now, traditional one, same thing. You can invest, $5,500, and that does adjust each year. So the government will go and decide, and I would imagine a year or two it'll be different. You'll probably be able to do more. And I will say that number changes a little bit if you're 50 years old and you're trying to, make up, for some lost years. They allow you to actually invest a little bit more money each year, maybe to offset that. But traditional, there is an age limit. So, I mean, obviously you have to be 59 and a half in order to start withdrawing money from there. But at age 70, you are forced to withdraw money from it, or you're penalized.
All of it, or just some?
No, just some. You have to start taking some withdrawals from it. See, the Roth, you don't have to do that. So if you don't want to touch it, because maybe you don't need it right now, and so you just don't want to, take
How
money
much
out
is
of it.
some? Whatever they.
What's that?
How much would be by some? Do you know that, like the number, or it's just like?
Like what your tax?
How much is take out, like? By that?
Well, I mean, I don't think there's like a set number. I think you just have to start taking something out of there. Yeah, so I mean, I would imagine. Now, I don't know if they'll say, hey, take $1, I don't know if they'll allow that, but I would imagine that it's not very much that you have to take out. But I do know you have to start withdrawing. And I will tell you, the majority of people are going to be withdrawing, before 70, for that. I just, for me, the Roth was a better choice because I just felt like there was more flexibility, with that. And I like the idea of paying the taxes now. The traditional one, you actually have to pay the taxes when you start withdrawing the money.
So you do it now and then?
No, you don't pay. You don't pay now. You don't have to pay now. But once you start retiring and you start withdrawing that money, then you are taxed.
And more likely some go up, like you said.
Yeah, and it could. I mean, so there's always that risk, that it could be higher taxes at that point. And so yeah, I mean, it's a bit of a risk. Now, some people like the traditional, IRA because whatever you invest, the amount that you invest each year, you actually get to deduct that from your income, your income tax. So if you invest $3,000, you get to deduct that, for that year. So that's nice. Some people do that, for mainly that purpose. And so, but for me, it was more the Roth that I liked. On that handout, and we are going to go to some of these websites and take a look at it in a little bit, show you actually how to do it. But I mentioned, the Vanguard Target Retirement 2060 Fund. I can tell you that there's a lot of different funds. What that means when you see that 2060, that is an index fund that is basically designed for the year that you will most likely retire. So I was looking at, most likely around the college student's age, and that typically, is going to be around the time that you most likely retire.
That's like 4 years from now.
Yeah, so somewhere in that range. That's kind of the ballpark. Now, that doesn't mean that you can't retire slightly earlier than that. This is just set up for when you anticipate that you'll most likely retire. So if you retire a couple of years earlier, it's not a big deal. And so now what I like about that is that you can set it up with a Vanguard 2060 plan as a Roth IRA, or you can set it up as a traditional IRA. You have the option of which one. So I mean, you do have the option with that. You can select that fund, and then you just you invest each year. Now the minimum to get started, which we'll look at in a bit, I believe is $1,000. That's kind of the drawback, in my opinion, with going through Vanguard. They do have a set number that you have to invest to get started. And so for some funds it's $3,000. Some funds it's $10,000. Depending on which one that you select. And so, to me, that makes it a little bit tougher, honestly. Because, yeah, it's a lot of money. And so we're going to look at all the different options here in a little bit. I just want to get through this kind of handout, and then we're going to look on the computer here, and I'll show you specifically how to do some of this. And so, but I do like the idea of that targeted retirement plan. Like mine, I have a 2040 plan. You know, I have a Roth, 2040 plan through Vanguard. You know, that's kind of the anticipation date. I'd be 60 at that point. And so I wanted to choose something where, you know, I'd at least be, you know, that 59.5 or above. And that's kind of why I went with that number. And so, but you do have, you know, lots of, you know, options. You can choose something slightly before that or after. I mean, so, you know, there are, you know, options there. Now, I hope that I will be able to retire before then. I mean, me personally, I want to be, you know, one of those people that get to retire like pretty early. You know, so I'm hoping to be able to retire early 50s, maybe even late 40s. So I've been saving since I was 19 years old. Right now, I'm right around $400,000 I have saved. So, you know, I said when you're saving 40% of your income every month, over time, especially with compound interest, you know, it's going to go up pretty good. So I'm hoping if I can continue to save the way I am, you know, hopefully, you know, around that 38 or 48, 49, you know, I will at least have the option. Now, I may not, I may, you know, like what I'm doing, I still want to do that, but I want to at least have the option, you know, on the table for me. And so, but yeah, so we will look at a couple of those things. Now, once you have reached 10,000, so let's say, Cody, for example, for you, let's say you decide to go with one of these targeted funds, the 2060 plan, we'll just say for argument's sake, and you decide to go with a Roth IRA because you like the idea of being able to pay the taxes now, you know, so that way you don't have to do it during retirement. One of the things that you could do eventually is just try to get it set up. You know, let's say you set it up, it's $1,000 to get started in there. You know, you're able to do that, and then you know you're contributing each year. You know, eventually you could, you know, I would imagine in time you're probably going to be able to get close to maxing out. You know, that 5,500, you know, a year. You know, if not more down the road. So one of the things that I would suggest that you do that until you reach 10,000. You hit that number, 10,000. Then I would say, you know, you can start looking if you want to buy individual stocks, because you can do that. And I do own individual stocks. I have 15, you know, different individual stocks, you know, that I own currently. I mean, I've owned more in the past, and I've sold some, made profits, moved on to another. So I've always enjoyed investing in individual companies. It's a little bit more work because you actually have to do research on that company. You really have to pay close attention to the price of those shares. You have to really, you know, focus buying when, you know, it's low. The concept is buy low, sell high. You know, so I mean, you do have to time it. And I can tell you in the beginning, I wasn't great at the timing. It took me a little while, you know, to kind of figure that stuff out. And so reading blogs and different things like that and books allowed me to kind of get a better idea of how to do that. And so it's not something that you learn overnight. I'm still learning this stuff as I go. And so...
so you have Nike on here, so that's probably pretty high.
Yeah, Nike is my biggest you know, investment that I have currently. Nike the past year has gone through, you know, basically the stock price has, you know, dropped significantly. You know, part of that is that they just have a lot of competition with Adidas and other, you know, places out there. You know, you've got, you know, so really the competition, you know, has been pretty tough. Now Nike, in my opinion, is more the gold standard when it comes to, you know that area, the sportswear.
Yeah, I think most people still use Nike, but like Adidas is like coming up and like.
Yeah, I mean they really have been able to rival them, you know, in the past year or so. But I do think Nike, their stock is going to go up. So betting on that, you know, I have been really loading up on those shares because I feel, you know, maybe 2, 3, 4 years from now, that price is going to be a lot higher than what I purchased it at.
Yeah.
And so I mean, I'm betting in a way on that. But I'm betting that Nike is a well-run company that they will be able to do that.
Yeah.
And so yes, Nike's share right now is around, you know, 49 something, or not 49, but 59 something a share, right there. So, and I'm going to show you how you can go and buy Nike as well here in a bit. So these are just a list of some individual stocks that I think are pretty good companies that down the road, you know, you could potentially, you know, invest in. You know, you've got British American Tobacco. Now, some people don't like, and they call these the sin stocks. So some people will not invest in them because, you know, they don't agree with what they're selling. You know, I agree in profit, so that's what, you know, I base my decision on. You know, I look at it as no one is forcing people to buy cigarettes and that stuff. So, you know, most tobacco companies do pay a pretty good dividend. And how many of you know really what a dividend is? You feel okay?
I the word, but
yeah.
Okay.
feel like I should know it. But
So think about it in this way first, because most of you know what a savings account is. You know, a savings account, you put it in now, they pay you, you know, interest for putting your money in a bank. You know, now I can tell you today, you know, those prices are, you know, what the percentage that they give you is really low. You basically make nothing hardly, you know, having money in the bank nowadays because it's so low of interest. Well, the company is basically, you buy stock, you know, in their company, and they will pay you for each share that you own. And they pay you, and that's what they call a dividend. It's part of the profits that they have. They, you know, give on to, you know, to their shareholders. And so every company is different on what dividend that they pay out. So, for example, you know, British Tobacco, they, you know, pay somewhere around close to 4%. It's like 3 point something, whatever, 3.8, 3.7, I don't know, somewhere in that range percent dividend yield a year. So most companies will pay you 4 dividend checks a year. So normally, because it's each quarter, and so every 4, you know, 3-4 months, close to that range, you know, you'll eventually get, you know, a dividend check. Now that dividend check, let's look at. I'm trying to think of like AT&T that's listed on there. AT&T pays over a 5% dividend yield. It's pretty good. They pay 49 cents for every share that you own. So every single share that you own, you know, each quarter. What's that? AT&T right now is around 34, something close to 35 a share, you know, currently. And so I think the last time I saw they were like, you know, 30 or 34. 34, you know, 0.91 or something like that. I mean, so I mean they're close to the 35 range.
Is that a high risk? Do you think?
No, AT&T I don't think is. I mean, to me that is they call it a dividend aristocrat, which means that it is paid basically. It has increased their dividend every year for over like 25, 30 years.
It's like a big chunk, or just like slowly, like
slowly. Yeah. And most of like, you know, the telecom, you know, companies pay a higher dividend yield overall, but you generally don't see their stock price rise significantly.
And so compared to Nike kind of like
yeah, they are
1 year and they kind of drop low.
They are considered a growth stock. So we have growth stocks, and then you have more dividend stocks. Some people are like what we call dividend investors. So that means they focus on companies that pay a good dividend, normally 3% or higher dividend yield. And then more of the growth stocks, you tend to see around like maybe 1%, you know, yield. Some don't even pay a dividend because all the money that you're really going to make is going to be off what we call capital gains. So capital gains, think about, you know, you buy Nike, let's say it's $60 a share, and then 4 years later, you sell that for $90 a share.
Yeah.
That $30 difference, that's the capital gain part of it. And so you are banking that the majority of your profit is going to be off capital gains. And so I try to have a combination.
How many shares do you think you should get if you, like if I was going to Nike right now, how many shares do you think I should start out with?
Well, I mean, I'm going to show you how much, there's a minimum that you have to buy.
Okay.
You know, so I'm going to show you that here in just a bit. So now I love Nike. I always have. You know, I believe in the brand. I believe in the company. I think you should always look for companies that are well run. And Nike is, just, in my opinion, is just one of those companies that's well run. I think they're just kind of going through a rough patch right now. But you know, if any company can weather the storm, it's them. I mean, their company, their value is worth right around $100 billion. I mean, it's a strong, you know, company. And you start looking at Adidas and some of the other ones, they're not even close when it comes to like how much capital.
I feel like it's just like that trend, you know, people want something new,
yeah.
and then once someone, you know, has something new, they want to follow that. It'll be like a year or two thing, then it'll kind of like, they'll go back to Nike, and that's what I feel like at least.
And
it's
see,
like with that
to
champion
me,
brand that became popular too.
That's when I see opportunity. When something's out of favor, but I know that they're still a good run company, that to me is a sign that maybe that's my time to invest. You know, because now if they're not ran very well, then obviously I'm going to move away. And I've bought some stocks that I'm going to have to hold on for a while because they're going through a bad run right now. A good example would be GE. You know, General Electric. I mean, they were a powerhouse, you know, back in the day. But to me, their management, General Electric, they have, you know, really, you know, management has been bad the past, you know, several years, and their price has gotten hit pretty hard here recently. So now, fortunately, I didn't buy a lot of stock in it. You know, I bought it when it was still kind of low. it's lower than what I bought, but I'll just hold on to it. It's still paying a dividend, you know, so I mean, I'll just, and what I do is I reinvest my dividend. So that's another thing I wanted to mention is that, so let's say AT&T, for example, it pays 49 cents, a dividend. And so, you know, I own, I think in that one, I want to say I own like 857 shares. You know, so you can imagine that it's a decent dividend that I get.
Then you just put that in, you get more.
Yeah, because you have the option when you fill out the paperwork, to buy, buy into the company. It'll ask you, do you want to reinvest your dividend, or do you want to reinvest a percentage of it? So it gives you some options that you can do. Since I'm not retiring right now, and I don't need that money right now, I reinvest all the dividends for all my stocks.
And then you add those up, you'll get a bigger dividend back too.
Yes, because and that's what we call the compounding interest. It just keeps accumulating. So I just keep buying more shares, with that reinvested, and it just keeps accumulating.
So it's like growing on its own.
Yeah.
So that's
Yeah.
cool.
Exactly.
And then when it does hit that bigger, that margin, it's like a good chunk.
And then you can decide, at a certain point, you do have to kind of rebalance, your assets. So you may own, 10 different stocks. Maybe you want to have a certain percentage. Maybe you don't want to have too big a percentage in one company. And so once it hits, you get a decent profit in there, you can start, selling a few of those shares. So you kind of balance out. Then you take that money and invest it somewhere else. And so normally I would say don't take money, from, don't sell shares unless you're up about 25%. That's kind of my rule. If I'm up around 25 to 30% in a stock, then I may consider, taking that profit and then maybe putting it somewhere else. Because you don't want to sell a lot, because that's when they get you with the fees. So I mean, if you're buying and selling like all the time, I mean, you're going to really get eaten, alive when it comes to those fees.
So there's fees for this?
Yeah, there are fees when you purchase, stocks. The question is how much, and that's when you got to start doing your research and deciding which ones make sense and which ones don't. So we're going to look at it.
Only fee to take them out.
Yeah, I mean, now some you have to fees for like when you purchase stock. Sometimes there's a fee for that. Sometimes there's a fee like it depends on the company. In order to get it, initiated, started. So like if you've never owned Nike or you never owned one of these companies, sometimes there's an initial fee, to get your account set up.
Is it like a big one, like $50, or is it something?
Normally it's a lot smaller than that.
A lot smaller than
so
that.
and it depends on the company. But I'm going to show you an example here in a second. And so, and then you see like I have a utility company on there, American Electric Power. I like utility companies because generally they pay a higher dividend. Most people that are dividend investors go for utilities because their price doesn't really fluctuate. The stock market price it really doesn't fluctuate a lot. It's pretty stable. So most of your money is going to come from the dividend. It's not a growth stock, and so you're relying heavily on that dividend for your profit. And so if you notice on there, I do have a couple websites that suggest that you can look. Obviously, I've got my shameless plug for my blog there, the okpiniventure.com. The only thing I'd say that's what I like about if you use that is that you can go to the resource page and look at other people's stuff as well. Because I never want a person just looking at mine. I think it's a starting point, but you can look at others. I look at other people's blogs all the time. So you should always be willing to learn, educate yourself. The other one that I have listed on here is that Rock Star Finance. I really like that blog because what it is, it's a directory that has like all the different personal financial blogs that are out there. I mean thousands, over 1,000 blogs they have listed on there that you can go and look at, and they just have a lot of really cool stuff. So it always suggests go on there, play around, because it's pretty fun. So what I'm going to do now, I'm going to come over here, and I'm going to show you where you can start going. So now that, let's say, Cody, you want to start investing. So what's the next step? So I would suggest go here, go to my blog. You can look at, now I've got articles that talk about what we're talking about now. So you can so if you look down here, yes, I have advertisement on there. I can make money now, when people click on these ads. So
just click on them?
Yeah, let's see here. Let's click on one, for example, here. See that ad that you see up there? You click on that, I get money.
So that's why these ads pop up on phones?
Yeah. When you go on and you look at other people's website, if you click on one of those ads, the person's getting paid for that.
Let's say we're on a game or something, like those ads pops up.
Yep.
Those people are getting paid for that?
Yep. I know. Now, you're not going to get rich. I mean, it's not a lot. They don't give you a lot.
But it's a little bit here and there.
But it's kind of cool. I mean,
like a lot of people click on them just because, like, sometimes there's no exit button.
Yeah.
Like, it's hard to find, so like, I'll click on this, then you're like, oh, crap.
Yep, they do that on purpose because they want your money.
Yeah, they make it, like, clear. Like, you have to know where it's either on, they'll change it to the left side and everything on you.
So if you look here, if you scroll down here, you know, one of the topics I have is creating your own investment portfolio. You know, so, I mean, I invest in companies that I feel like the only way they would go under if we have the zombie apocalypse. So you could click on this, and it would tell you kind of about what I'm talking about there. But I invest what I consider safe companies. I don't want to lose money. So, I mean, I don't want to invest in what I consider risky companies. A lot of people think, oh, maybe I could buy some penny stocks. You know, chances are they could go belly up and you could lose your money. I want to invest in companies that I know are well established, that the only way they're going under, if you're in the zombie apocalypse, except for Nike, because you probably need running shoes. So, but if we go back to resource page, so the personal finance resources, scroll down here. This is where I have a variety of just different tools that you can use. You know, whether it's, you know, the calculators, you know, where you can start calculating for retirement stuff, stock purchasing agencies. So this is, you know, some places I've been to. All these, I have accounts with every one of these that you see here. So first one, let's look at ComputerShare. We'll go to ComputerShare real fast because if you're wanting to buy individual stocks, so this is just one place that you can go to. So this is what we, you know, is ComputerShare. So if you decide that you want to purchase an individual stock, this is one of the places that you can go. So you go to the website, then you click on Buy Stock Direct. It's a little slow. Okay, so, and there's like a, you know, a search where you can search for different companies. Over to the right, it just kind of talks about some of the most active, you know, plans that are out there. Ones that people buy a lot of stock in, it seems. So if you notice here on the side, you know, you got like ExxonMobil, Coca-Cola Company, Johnson & Johnson, Walmart, AT&T. So let's click on AT&T, since that was on my list there. Sometimes it messes up. Sometimes I got to go back and click it again. Okay, so let's take a look at some of those fees. So as you're looking through here, you know, you notice that, you know, the first two things says, you know, about the brochure. You can view that. It has like all the information that's about the company, all the different fees, and just, you know, kind of the prospectus that, you know, goes all over the details. You can actually print off the enrollment form and mail it in. That's if you wanted to buy stock, or you can just do it online. I mean, so you have a couple options. The minimum purchase, if you want to get AT&T stock, you have to at least the initial start is $50 or is $500. You got to have $500 to get it started.
And so they're each one is $50 for them, I take it?
Yeah, after you have, you know, invested, you know, the first initial $500, going forward, the minimum then is $50. So sometimes it costs a little bit more to get started, but after that,
yeah,
it's less. Now this is just one example. Now look down there at the fees, and this is what I try to pay close attention to. So, you know, in order to set up your account, the initial setup fee, $10. And then if you know, a cash purchase fee, if you're sending a check or whatever, $5. And so now the $250 is only if you do like an automatic, like where it comes out of your bank account. So like if you decide, you know what, I'm just going to have them take $50 out of my bank account every month, then there is a fee. You know,
so that'd be a better idea, but I feel like you shouldn't get paid for that because they know they're going to get their money.
I know.
I feel like that'd be a better way for them to get.
But see, every company's different. Like I'll show you another example. Look at ExxonMobil. Look at their fees.
That's fine.
See? And that's why I say, you know, it's good to get on here and just look around. You know, I mean, I look at that. Now,
well, then you went back still.
that means like if you're going to sell, your shares, what that means is that, and this is kind of a con, you know, when you're going through ComputerShare and some of these other places, they sell shares a certain time of the week. So let's say you decide, you know what, it's, you know, let's say you bought it at $60 a share, it's $80 a share, and you're like, man, I'm selling. Well, you send in the information. It can take close to a week in some cases for them to sell it. So the price may be different in a week. Because what they do is that once they get your information, they're not going to just sell your, your shares, right then and there. They're going to wait until they have a variety of different people that are wanting to sell their stuff, and they kind of do it in bulk a little bit. Like, so they'll do it on a Friday, and they'll sell whoever, said,
Do you
sell
get
their
warning
shares.
for that?
What's
Do
that?
they kind of like let you know about that, or they don't like
No.
even respond? You just like
Yep.
have to wait.
Yep.
So
So,
like, it could go back down a little bit by then too.
yes.
Dang.
Yes, that is one of the cons. And so that's why I say I don't sell shares unless I'm up 25, 30%.
Yeah.
Because I have my margin, my safety margin. And so hey, and I've sold some shares that I started paperwork, I sent it in, and when I sold it, it actually went up. It went up, just right before I sold it. So I mean, it's a risk. I mean, it's a little bit of a risk. But I would say if you are, out on a very small margin, I wouldn't sell it.
Yeah.
Because you just don't know.
Make sure you have at least, if it goes down a little bit by then, you're like, I'm still getting
Yeah.
$49 back.
And so you just have to kind of, timing and stuff. But what I like about the dividend reinvestment fee, the company pays. So when you decide to reinvest your dividend, they don't charge you for that. Some companies charge you. Now some charge you maybe like $3 or whatever, or 5% of whatever your dividend is. So if you're only making $30, each dividend, you take out 3%, 5%. I mean, it's not a huge amount, but you do want to pay